Welcome to The Explainer. You ever wonder how a business actually knows if it made money at the end of the year? Well, a massive piece of that puzzle is something called closing the books. And today, we're going to dig into the two main ways companies do this for inventory. You've got the classic, old-school method versus the modern, real-time approach.
So, here's our game plan. We're going to start with the basics, what closing transfers even are. Then we'll introduce our two main players, the periodic and perpetual systems. After that, we'll see how each one handles buying stuff and figuring out the cost of what they sold. And finally, we'll see it all come together in a big showdown to find the profit.
All right, first things first. What in the world are closing transfers? Well, you can think of them as a giant reset button for a company's financial records at the end of the year.
So what that really means is closing transfers are these final accounting steps you take for the year. The whole point is to take all those accounts that track your performance, things like sales, rent, and salaries, and just wipe them clean, zero them out.
And this whole reset process does two really important things. First, it pushes all that income and expense info into one place so you can finally calculate your actual profit or loss. And second, it totally clears the slate so those temporary accounts can start fresh at zero for the new year. Now, permanent accounts, like your cash or your loans, they're different. Their balances just roll over.
Okay, now this is where it gets really interesting, because the way a business keeps track of its inventory, it completely changes this entire closing process. So let's meet the two main systems, periodic and perpetual. First up, we've got the periodic system. This is the more traditional, kind of old-school way of doing things. Imagine you run a small shop. You write down when you buy new inventory, sure, but you don't actually track the cost every single time something sells. Instead, you wait till the end of the year, roll up your sleeves, and physically count every single thing you have left. Only then do you figure out what you sold.
Now, the perpetual system is, well, it's exactly what it sounds like. It's a live, non-stop record. Just think about a modern grocery store checkout. The second that scanner beeps, the system doesn't just record the sale, it instantly updates your inventory records in real time. It's continuous.
And this slide just nails it. The periodic system is like taking one single photo at the end of the year. Your profit is this big, dramatic reveal. But the perpetual system, that's like having a live video feed. You have a constant, up-to-the-second dashboard showing you exactly how you're doing.
All right, let's get into the nitty-gritty here. The first really big difference in the closing process pops up when we look at how each system handles the stuff you've bought.
Okay, so what you're seeing here is something totally unique to the periodic system. Think of it like you're baking a cake. You've got separate little bowls for different things, one for your purchases, one for any returns you made, and another for discounts you got. At the end of the year, you first mix those little bowls into the main purchases bowl to get your net purchases, and only then do you pour that final mix into the big trading account pot where you figure out your profit.
But the perpetual system? Oh, it's way more direct. It's like having just one big bowl, the inventory account. Everything you buy goes straight in. Returns, discounts, they just adjust that one single account. It's so much cleaner, with way fewer moving parts to deal with at the end of the year.
Now this next bit, this is probably the single biggest, most important difference between these two systems. It all comes down to figuring out the cost of sales.
See, with the periodic system, you don't have a cost of sales account that you're updating all year. Nope. It's basically a math problem you have to solve at the very end. The formula is pretty simple. You take the inventory you started the year with, you add everything new you bought, and then you subtract whatever's left on the shelves after you count it. Boom. That final number, that's your cost of sales.
But with the perpetual system, all that work is already done. You've got a cost of sales account that's been doing its job, tracking cost with every single sale all year long. So when it's closing time, there's no big calculation. You just take the final number from that account and move it over. It is incredibly simple in comparison.
So let's bring this all home. We're going to look at the trading account, which is basically the arena where you calculate your gross profit, and see how these two very different methods stack up.
And this table just lays it all out, doesn't it? Look at the periodic system on the left. It's busy. You've got all these different pieces, opening inventory, net purchases on one side, and sales and closing inventory on the other. You are literally doing the cost of sales math right here in this account. Now look to the right. The perpetual system is just so clean. It's just your total sales against one single pre-calculated cost of sales number. Here's the kicker. They both get you to the exact same gross profit. The journey there, though, could not be more different.
So after all the accounting gymnastics, what's the real takeaway? I mean, beyond the debits and credits, why should a business owner even care about any of this? What is the actual real-world impact?
It really just boils down to a trade-off. The periodic system is simpler during the year, for sure, less data entry, but it leaves you flying blind about your profits until you do that huge, time-consuming stock count at the end. The perpetual system, on the other hand, it requires discipline, that real-time tracking, but the payoff is massive. You get powerful, instant knowledge about what's selling, what's not, and what your actual profit margin is any day of the week.
And that brings us to our final question. In today's world, with fast-moving e-commerce businesses, where your website has to know your exact stock levels to avoid selling something you don't have, which of these two systems is no longer just a preference but an absolute necessity? Thanks for joining us on The Explainer.